Alright traders, in today's video we're going to be discussing liquidity. What is liquidity and how do we identify it? Liquidity is just a collection of orders sitting in the market, whether they're stop losses or pending orders that will be executed when price gets near or interacts with certain levels of supply or demand in the market. In essence, we are all liquidity in the market. Liquidity helps us determine where price is likely to go next. We can get a good idea of where price will be magnetized to and use that information to help us form good quality trade ideas. Popular areas where retail traders would usually enter a position are equal highs and equal lows, support and resistance levels, trend lines, channels, and Fibonacci zones, like the golden zone, the 61.8. These are all places where retailers are likely to enter into the market with pools of orders waiting. Smart money knows this and aims to grab liquidity in these areas. So if you just look at these for an example, the first one we've got equal highs. So we build these consolidation areas of equal highs and equal lows, and this is actually where the liquidity is waiting, up here and down here. So for instance, the retailer usually would enter a short over here and they would place their stop losses here, or they would enter a long over here and they would place their stop losses down here. The smart money knows this. So what it does is it builds these equal lows and equal highs and then whoosh, takes out the market, grabs the liquidity from all the stop losses at the top, comes down, grabs all the stop losses here, therefore building its position with all this liquidity and then making its move higher in the trend. And here we go. In trend lines and channels, it's the same. We form these liquidity points in this channel, all the liquidity stored up here from the stop losses, all the liquidity stored here from the stop losses. Smart money knows this. So what they do is they build this, they trick the retailer, and then all of a sudden they break out of this trend, grab the liquidity, shoot down, grab the liquidity, and then carry on their move. And here in the Fibonacci level, they do the same thing. So most retailers would enter positions at the golden pocket over here, 61.8 or the 65. And what happens is, as price reaches this place, all the retailers are going to enter here and all their stop losses are typically going to be just below it. So the market maker knows this, comes down, forms another equal high or equal low here, and then inevitably breaks it to grab that liquidity. So these are typically where liquidity is forming on the equal highs and lows, channels and trend lines, and Fibonacci levels. This is where the retailer is traditionally taught to enter their positions. Smart money is aware of this, and this is what they play on in the market. They know where the retailer is placing their stop losses, and they will grab the liquidity from those areas. Here's an example of equal highs. So as you can see, we've got an equal high over here, comes down, another equal high over here, inevitably breaks that structure here and takes out those highs. So what a retailer would do is they would enter a short right over here, price would drop, mitigate this order block that would be here, and then shoot, you can see this shot up with power, taking them out and absorbing all this liquidity from their stop losses that were stored in this region. Here's another example of equal lows, same kind of thing. Price hits here again, comes up, hits here again, and there you go. We've got a great area of liquidity being stored in this area. And then all of a sudden, price breaks with velocity. You can see this velocity. It took it out, and then buy to sell candle, and then shoots up again. And what will happen is the retail trader would enter a long position here. Price would shoot down, break, then take them out, and then all of a sudden they would enter a short over here, and then it would shoot up and take them out again. And this is why sometimes you can't figure out how to get on the right side of the market. As an example of a trend line, price comes up, hits this region, comes down, hits this region again and again, and now it's hit it 1, 2, 3 times. So the retailer assumes the fourth time it's going to do the same thing. So he enters a sell position here, stop loss just above this region. Market makers know this. What they do is break up, then all of a sudden liquidates the retailer. Then the retailer decides, okay, I'm going to go into a long position instead of a short. Enters a long and then breaks down again, takes them out again, and then goes in the opposite direction. So it's kind of like this whipsaw action. Breaks up, breaks down, and then breaks up again. And you can see it also took out these equal highs. It broke the trend, created an equal high, and then broke the equal high as well. Here's a bullish trend. As you can see, liquidity is building over here. Price keeps coming back to this trend line. And then over here, the retailer would think, okay, I'm going to enter another long position. But then price breaks down, liquidates them, forms an equal low over here as well, and then breaks down with velocity. You can see these candles, they're literally massive sell orders, then massive buy orders at the same time, just to create this whipsaw, which takes out the retailer on both sides of the equation, therefore fueling the next move for the market maker. Here's an example with Fibonacci. So what happened is price came all the way down here. We got a high point, low point. So typically we drag our Fibonacci from the low to the high. And as you can see, we've got the golden ratio right here. Price would come up to the golden ratio. Most retailers would be looking for short positions over here. And price would actually break through, mitigate this order block over here, tap into this premium zone of 70, 50, and 79%. This is where the smart money traders would enter. And then price would drop again. So you can see how the market makers are constantly tricking the retailers. And typically the traditional way retailers learn, it only serves to trap them in the market, and they become the liquidity for the banks, the institutions, and the market makers. All right, let's check out the charts and look for some examples there. So let's go to Bitcoin, and here we go. We can use some examples. I've got this really great indicator that marks out all the equal highs, the boss and the chalk, so it makes it super easy. So here we go. We've got an example of price coming up here, coming down, coming up, creating this equal high, coming down again, mitigating this order block, shooting up, creating another equal high, coming down, mitigating this order block, and then breaking this equal high over here, breaking this, shooting up, tapping into this liquidity over here, coming down, tapping into this liquidity over here. It's amazing how the market just keeps repeating the same thing over and over again. And once you can tune your eyes to it, you'll start seeing it everywhere. Price taps in, shoots up here, comes down, shoots up, creates another order block, taps into it, comes up again, drops down. Let's look for another equal high. Here we go. So price comes up here, comes down, comes up, creates this equal high, breaks it, taps into this liquidity over here. Then we have this massive drop down, creates another equal high here, 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 and over here. And as you can see, it's just broken this equal high, broken this equal high. So we can almost expect and know what's going to happen now. We know when equal highs are created in the chart, they get taken out every single time. If you look at the chart, every time you see an equal high, it's been taken out. Like this equal high was taken out by this. Now what I think is going to happen, this is going to come up, tap into this order block over here, come back, take out this equal high, and then probably continue its move back to the upside. So check it out, the chart. Do some back testing. Look at the chart, mark out the equal highs, and you will see for yourself at every single time price takes out these equal highs, because that's where the stop losses of the retailers are. It serves as liquidity for the institutions, and this is how they make their money. Thank you for tuning into this video. See you in the next one.